Hello investors, welcome back to the channel. As a quick background, I'm a former finance professional. In this channel, we discuss topics like stocks, markets, options, investing, financial analysis, real estate, and personal finance. Please press the subscribe button below if you're interested in any of these topics. As I'm preparing for videos that talk about the specifics of investing in the markets, I wanted to first share some of the important points about investing. And I thought it'd be worth spending a couple of minutes going over investing philosophy at a high level because I certainly wish I knew all of these when I first started out. Having the right mindset is such an important part of not just investing, but also anything in life. This is because your mindset will ultimately determine your actions. It'll dictate your actions when the S&P is falling 10% every day. It'll help you decide whether to save up your money to buy a home or pay down your personal loan. It's sort of like having the right navigation system when driving a car. You can't drive on an outdated map. Having the right mindset is the most important part of investing, and this is something that I've been taught by my mentors. Now, what does a right mindset consist of? In my opinion, the below 5 factors are the most important ones to keep in mind when it comes to the markets. First is being open-minded. What this means is not just being open to trying new things or ideas, but also challenging your conventional beliefs. Ray Dalio is a zealot of this point, and he's one of the most successful hedge fund managers in the world. He believes in something called radical open-mindedness. He encourages everyone to be open to something that may challenge our beliefs. For instance, I used to believe that the only fundamental analysis matter in investing. Fundamental analysis means that you believe a company's business model and its ability to generate cash flows are the only things you need to analyze to predict its future performance. However, many professional investors and traders look to technical analysis. Technical analysis is opposite of fundamental analysis, and it's analyzing stock charts or patterns to predict the stock's next movement regardless of what the underlying business does. Before, I didn't really believe in technical analysis as it seemed very arbitrary, like you just draw a random line and if the stock crosses that line, you buy. It didn't make any sense to me and it felt like gambling. Over time, I've learned how important technical analysis is in making an investment decision, which nicely leads to the next factor in having the right mindset. Mosaic Theory basically says you can only see the complete picture after you have assembled enough pieces of the puzzle. A fundamental analysis is one piece of the puzzle. A technical analysis is another. Valuation analysis is another piece. Portfolio risk weighting is another. It's only when you combine all of these pieces that your analysis is that much more comprehensive. It's incorrect to ask which is better, fundamental or technical analysis, because both matter. The right question to ask is, what pieces am I missing to complete the picture? Remember, the goal is to generate a high return with low risk. That means you have to nail not only the business model of the company, but also the stock price movement and the appropriate weight of that position in your portfolio. It's through these types of analysis and thinking from all different angles that lead to a complete picture. Investing is also a game of probability, like poker or blackjack. Please don't misunderstand this point by treating investing like gambling. That's not what I mean at all, and to be very clear, I do not mean investing is gambling. There's no perfect analysis in investing. You can't have a guaranteed return, needless to say, but you can have a high risk-adjusted return. And let me explain what I mean by that. An example I like to give is a coin flip. Let's say you get $100 if you get heads and you lose $100 if you get tails. Let's also say you have a weird coin that has 10% chance of showing heads and 90% chance of showing tails. Obviously, no rational person would take this bet because you have a 90% chance of losing $100 and you only earn $100 when you win, which is enough reward to entice any rational person to take the bet. This is a case where the risk-adjusted return is low, meaning your reward of 100 isn't enough given the risk you're taking, which is 90% chance of losing $100. But let's say your friend next to you took the bet and got heads and earned $100, and then your friend goes, "You're so dumb, why didn't you take the bet?" Think about that for a second. Doesn't that sound pretty familiar? It's exactly the words you hear from your friends, girlfriends, boyfriends, or families when you miss out on the GME or AMC bull run. Any rational person would never take the bet because the odds are against you. You have 90% chance of losing $100 and 10% chance of gaining 100. Your reward isn't enough to take the bet. And it's exactly the same thing in life. Is there a chance that you might get hit by an airplane debris falling from the sky when you walk down the street? Possibly, but the chances are extremely low. It'd be irrational to stay at home just because you're afraid of getting hit by a debris. While the outcome may be devastating, the risk of getting hit by debris is too low and your reward for taking that risk is reasonable. You get to go out, enjoy the sun, meet people, play golf. Stanley Druckenmiller, one of the greatest traders of all time, can have a high conviction on the movement of a 10-year treasury yield. The next year, he gets it wrong. Does that mean his analysis or opinion was wrong? Of course not. Even if he has a 95% conviction, there's the 5% chance that it doesn't play the way he thought it would. All I'm saying is, results and reasoning should be independently judged. Good results and bad reasons don't mean much, like following into the hypes of meme stocks, because chances are you'll get bad results in the future based on the same bad reasonings. Daily trading is inefficient for the retail investors, and we lose the edge that we may have had in a long-term investment. I understand that everyone wants to receive those calls on next week's movement or where the price will be at the end of the day. It's perfectly fine. I've been in that boat too. I strongly suggest you look at the bigger picture. Is that 5 to 10% intraday movement really important when you can earn 5x your money over 5 to 10 years? Say you get weekly call options on Disney. You can 5x your money in 3 weeks through the weekly options. The next week, you can lose all of your 3 weeks worth of gains. Don't be illusioned by that 20% price run-up in 1 week. Tesla has been up more than 500% in less than 2 years. Fastly has gone up 3x. Those 10 to 20% movements in a day mean nothing in the grand scheme of things. Diligence is also really important in investing, and I've made this mistake myself as well. I haven't done enough research or homework and asked some questions that could have been answered in 2 seconds through Google search. Not only your own research saves time, but also it stays in your head longer. Please keep your emotions out of the discussions. We are here to educate each other purely for the purposes of helping each other. Even if I say things like, Russian companies may present good opportunities and can disrupt the e-commerce industry, that doesn't mean I favor the country from taking over the world or anything like that. We are here to determine what the company will be in the future, not what it should be. Thank you all for watching, and make sure to press the subscribe button below if you liked the video. See you all on the next video.